Hello, welcome to our panel at Con V2X. We are going to be talking today to a couple of folks who are experts in the health tech analyst space. We're going to find out what that actually means, what being a health tech analyst means. We're going to talk about their thoughts on many of the comings and goings, the M&As, the funding, the reality of what's happening, particularly in the telehealth, digital health space. My name is Lyle Berkowitz. I will be your moderator. My background is as a biomedical engineer who became a physician, who became an entrepreneur. So I've been fortunate enough to do everything from take care of patients to be a health system executive, running IT and innovation at Northwestern Medicine, a large health system in Chicago, as well as be the chief medical officer for a variety of public and private companies, founder of some companies, and board member of a variety of companies as well. And I love the health tech industry and follow it closely. And I'm super excited to introduce our panel. I'm going to give very brief introductions. They all have a lot deeper, richer info, but we'll hear from them in a minute. We have Jailendra Singh, who is the Director of Equity Research for the Healthcare Technology and Distribution arm of Credit Suisse, and he covers a lot of the health tech. So he's your classic analyst. We have Micca Lindenmayer, who is a special advisor to the Tata Trust, who I've become familiar with. They focus on health, nutrition, education, and livelihood in India. So it gives us more of a global perspective. And we have Peter Micca, who's a partner at Deloitte & Touche, with over 30 years of experience in the healthcare and life sciences industry, and is their national audit industry leader for health tech. So all these folks are experts in understanding health techs in a variety of ways. But I'm going to start off a question to all of them, and we'll go in the order that I had said. What does it mean when say health tech analyst? I think I usually think, oh, that's someone at an investment bank who's sort of studying. Jalandra, maybe more the classic health tech analyst. But I want to hear from each of you your definition briefly of how you explore the health tech industry and what you provide to your company and clients, et cetera. But Jalandra, you're sort of the classic one that we usually think about. Tell us what that actually means, what your day-to-day life looks like.
Sure. So thanks for having me. I really appreciate. So I'm Jailendra Singh, healthcare technology analyst at Credit Suisse. So I do equity research basically. So my main focus is to cover publicly traded healthcare IT companies. What that means doing like due diligence on those companies, speaking with management, building financial model, building projections, and using all that information and data to formulate our investment opinion and give recommendation to our institutional investor clients like BlackRock, Wellington, JP Morgan, T. Rowe. So all these clients, all these are our clients. But healthcare technology and digital health space is very unique in sense that if you are only focused on these publicly traded healthcare digital health companies, you're missing out on a lot of interesting stuff happening in the space. There's so many innovations, so many disruptions happening in the private market. So we have to keep up with, speaking with private companies, CEOs and founders, what they are doing, what market they are disrupting. So I'll say probably our job has got a little bit more tougher compared to 3 years back when we talked about healthcare technology. Names you will say are like Cerner, RCM, Allscripts and Athena Health. But now there's so many players out there, so many point solutions disrupting the way healthcare is being consumed or accessed. So probably I'll say our day-to-day job has really evolved over the past couple of years, given how much focus has been on the digital health space. But that's the gist of what we do, and happy to share our thoughts on different topics we're going to cover.
Right. Yeah, and that makes sense. So I think you're right. We usually think about covering public, but in fact, these days, you never know which private is either going to be acquired or go public. Every day there's a new one. Michael, tell us a bit about what you're doing with Tata Trust in general, and how similar is it to what Jalandra mentioned? How different? How do you cover the industry, and how do you bring value to your company?
Dr. Berkowitz, thanks for moderating this panel today. I really appreciate it. At the Tata Trust, it's India's largest and oldest charitable trust. And it is a 66% owner of the largest industrial group in India, which is the Tata Group, Tata Sons. And so one of the things that I do is I build out their international partnerships. I also have a director's role over at the Stanford School of Medicine, where I look at big data and development. So what is a health analyst in my remit? So I'm one step closer to the companies. The problems I'm trying to solve for is how do we get the best medical advice, interventions, and devices to those who are least well off, which is the vast majority of the planet. And so when I'm looking at companies, for-profit, non-for-profit, social impact, I ask the question, can this reach these kind of people in difficult to reach places? Can it ensure their same quality that you would be provided if you were in a more wealthy environment? And then also looking at how does that technology fit and suit the situation in which they're located. So in a high bandwidth, highly connected, high density environment with doctors, that's probably the environment that Jailendra is looking at. I'm looking at, these environments where you may have low bandwidth, you may have limited device distribution, and you will have a limited population of doctors. So it's that challenge that I look at. And it's the same set of people who are building these large companies that Jailendra looks at. They're also very interested in this segment. And so I've had a chance to work with a lot of different players who are at the bench to field innovation stage, as well as very large companies who are saying, actually, how do I reach this, less served audience?
So you really look at it with a specific filter on helping the underserved in a variety of ways, et cetera. So immediately can take a different angle at it.
Yes, reach the maximum number of people on the planet.
That's awesome. Okay, so Peter, you're at one of the big consulting companies. You work on the audit side, et cetera. Tell us a little more. How does that work? Does Deloitte serve internally? Are they constantly following all the companies for their clients? Tell us a bit about your job. And quick reminder to everyone, go on mute if we're not talking so that the person who's talking will always show up on the screen.
No, I appreciate that. Thank you for the opportunity. At Deloitte in our health tech practice, we've really followed a lot of the mega trends in the overall industry around consumerism, the convergence amongst the sectors, and the impact of the regulatory environment, really accelerating the adoption of innovative technology, accelerating the adoption of many of the trends that we see, whether it be value-based care, social determinants of health, et cetera. You can't help but look at all of the emerging growth companies that have some form of intellectual property, software as a service, or some unique service that's accelerating, that adoption. And it's an important trend. I think, many refer to the fact that you need to look at early adopters. We are very focused on emerging growth companies that are either venture-backed, private equity-backed, or have some form of corporate venture. And we're seeing non-traditional market participants, play a significant role, outside of this industry. And so, we view it as the white space of our industry. It's defined by what it's not. It's not a traditional healthcare provider. It's not a payer. It's not a pharmaceutical company, but it is accelerating many of the mega trends that we see in the industry.
And are you following them in large part to tell your health system clients and or large vendors about them, or following them to try and get them to sign up to work with Deloitte in some way or some other? What's the main focus of what you're looking at them for?
I think we think it's both. I think large established healthcare organizations have a lot to learn from emerging growth companies. Many established healthcare organizations are dipping their toe into the venture pond themselves. But we think understanding those emerging technologies are important. We're seeing an acceleration of alliances and the adoption of ecosystems where these established organizations collaborate in some way with these emerging companies. So it's a bit of both.
Okay, makes sense. So let's jump into evaluating the markets. Let's start with the public markets. And we'll go with one of the bigger ones, Teledoc. And their acquisition of Livongo was one of the biggest deals in health tech in the past year. As they did this, right, they acquired Livongo for close to $18 billion when their market cap was, I think, in the 40 billion or something. And now their combined market cap is about 22 billion. Would love each of your takes on what's going on there. And is that a success because they've captured more of the market? Was it a failure because the stock price went down? Jalandra, you're squarely in the middle of this. What was your take on this? And did you see it coming? Were you high on Teledocs? What's Credit Suisse saying about what happened and what you think is going to happen in the future?
Well, did we see it coming? Obviously not. We're not supposed to know that it's coming, right, from compliance perspective. But I will say that we were actually a lot more skeptical about Teledoc model before Livongo transaction, because our view was that the core telehealth business from their market point of view was hitting a saturation level where growth was difficult to come by. So we actually like the transaction. I know it's a little controversial. They paid pretty decent amount of money, but we have been very positive on the transaction ever since it was announced. Again, putting valuations aside, and I would note that a large part of the deal was done with Teledoc's own stock. But from a strategic standpoint, I think it was almost necessary for Teledoc to diversify their business. I mean, being the two leaders in their respective markets, they were bound to run into each other from a comparative standpoint at some point in the near future. So it made a lot of sense to combine versus compete with each other, in addition to all the other comparative threats already in existence and threats that would arise over time. We actually did our own detailed analysis in terms of quantifying the revenue synergies that were outlined. I think the opportunity is quite real. There's a lot of negativity around the transaction, but I still think that beginning next year, we will start seeing the real impact because of the timing of selling season. This deal was announced in August. The deal that did not close until November of last year. And large group selling season happens in July and August timeframe. So for 2021, selling season was almost over when this deal got closed. So it's the real impact from that combination will happen next year. So in 2022, we're already seeing, the company has shared some data points, how they're seeing some new client wins and all. We are very, very positive that you're going to see.
So you certainly like synergy, the big dog getting bigger. The industry usually likes to see that. Did the stock fall because the public didn't like it, or was that just going to happen anyway? Was it just too high anyway, and it was bound to happen? Because it seemed like it was a pretty large drop in the overall valuation. Relatively soon after the acquisition. Was that coincidence? Was that that the public didn't understand or didn't appreciate that spending so much stock on this, or just the nature of the cycle of telehealth peaking during COVID, and as things calm down, maybe people's excitement about telehealth waned a little?
Well, if you look at the chart, yes, it did decline initially, but stock did bounce back. Stock traded almost like $300 after Livongo transaction, like late last year and early part of this year. So it's not like stock has been straight down since the deal has been announced. Having said that, I will still say people are skeptical because their view is, why did Teledoc have to spend like almost $18+ billion to buy this company? Why couldn't they do it on their own? Mm-hmm. Yes, but in this fast moving market, evolving market, you really want to spend 1, 2, 3 years trying to invest on innovative products and then start getting traction. Competitors are already moving ahead pretty fast, pretty quick, and there's a lot of consolidation happening. You want to be staying ahead of the game. And COVID actually changed things so fast, so dramatic in remote patient monitoring, in chronic care management. You don't want to be left behind trying to innovate new solutions when everybody's already selling those solutions to employers and insurance companies. So from that point of view, I think it was something they overpay. Time will tell, right? If they don't hit synergies, if they don't get best out of these combination, then probably I'll say yes, they overpaid. But I think it was just the need given how the market was evolving. And the other things like the way stock shares have performed over the past 6 months or so, it's more around just overall digital health space getting reevaluated. We are in this transition phase where we are pretty much like kind of done with the COVID impact on digital health, but we're still not out of, we're not in a new world. So we don't know how the new world is going to look. We are still like making all these estimates. This is what telehealth might look like. This is what RPM might look like. This is what mental health might look like. But nobody has really good insight how the new world is going to look. So we are in this transition phase, which is creating more volatility in the space. And that's why I think not just Teledoc, I mean, most digital health names have been under pressure.
Yeah, and certainly one of the trends we're seeing is more and more the M&A. Micah, what was, if you have a take on Teledoc or telehealth in general, right? I mean, we talk about bringing healthcare to the masses. Telehealth has that opportunity. With that said, Teledoc and what they're doing is they focus a little more on payer and employer sponsored. But your thoughts on telehealth in general, and also specifically the Teledoc Livongo deal, and was that something you looked at as good from your filter?
Okay, so I just want to put out this as my opinion and not that of the Tata Trusts, just for putting that into perspective. So I think the question about these kind of deals is over what time horizon. If you hold that stock just for a few, short period, you're going to feel like you just, got punched in the gut. But if you hold it over the long run, you have to ask yourself, do you think that this group of people will make wise decisions to capture the present and at the margin growing digital consumer? The bigger question would be, and I think this is interesting that Jalandra said that, we're kind of at the end of the COVID-19 impact on accelerating digital health. I think three things happened during this brief period, which then I will sort of say why I think this impacts Teledoc and others like that. One is we pulled forward about 5 to 7 years worth of innovation cycle. People took all kinds of bets. Valuations remind me, I came from an investment banking background. They remind me of certain periods where people didn't have an easy mark. And so there was a lot of liquidity, few players, that creates scenarios of extraordinary valuations. So I think across the board, you're going to see right sizing of valuations. That doesn't mean that the trend is wrong. It doesn't mean that consumers don't want more digital health. It doesn't mean any of those things. It just means, whoa, we put a lot of liquidity behind a few players. And so I think that's what you're going to see. Public, private, both those environments are facing that. There'll be a lot of damage, but there will also be very strong winners. So from my view, I think a deal like this, is a good group of people coming together to pursue that. The biggest question, I think, period, for all of digital health is, will consumers use digital tools to actually change behavior? And that is the single biggest question, given how widespread non-communicable diseases are. So I think that's the big question someone has to ask when looking at these things. If you believe yes, then jump further in. If you think if you stick them with 1 million wearables and they still are going to, do whatever it is to exacerbate their diabetes or whatnot, then no, this isn't the right path. The right path is, someone in person.
Yeah, and it's a great point to bring up. We recognized this many years ago when all these companies would come out with, great results. because quite honestly, they're working with a bunch of high-tech savvy people on the West Coast who already wanted to improve their diabetes, that it really wasn't the app as much as the motivation of the people. And I think that will be critical, which, by the way, always, as editor-in-chief of Telehealth and Medicine Today, we're always looking for articles from the smaller companies or larger ones to say, what evidence do you have that this is really working? I think we need to see more published research and data on that. So it's a great point. And if it's positive, things will go up. If it's negative, then we're going to have to rethink how we do things, and we'll see who can do things differently. Peter, so we've heard from Jalandra and Michael that they see some positivity about the big gain bigger in this case, and what's going to happen in digital health. Do you agree, disagree on some of these, and what are you telling your internal clients, your external clients, et cetera, when these big deals happen?
Yeah. So I'll direct my comments to the broader telehealth market. And obviously COVID accelerated the awareness around telehealth and telemedicine in a way that, only an event like this could do. But the ingredients that drove the initial adoption there were really two things. One was the breakdown of some of the regulatory barriers that existed at the time. And secondly was reimbursement. Virtual visits were being, reimbursed at a level that was consistent with face-to-face visits. And, that drove an opportunity for market participants to try to get to scale. And, the law of economics, held and consolidation ensued. I think to Michael's point, the future of telemedicine will largely center around reimbursement trends and what that will look like. Some of the larger existing market participants on the financing side can certainly drive or steer the adoption or accelerate the adoption of telehealth just through policies around reimbursement and the regulatory environment around physicians crossing state boundaries. Can this be done virtually, on a national level? Will largely drive adoption. And, I think to some extent we've seen years and years of consolidation that typically occur in other sectors transform in just a little over a year, right? And so now there are kind of a small subset of, leading, telehealth organizations. Many traditional healthcare participants are, developing and driving their own solutions. But at the end, I think it will come down to how it gets financed and funded and the eventual regulatory environment.
And so let me ask some specific questions here now. So to Peter, so with Teledoc, being sort of the largest telehealth vendor, and you've got a couple of others, you've got the, Amwell's, Doctors on Demand / Grand Rounds now, et cetera. Cigna, who bought MD Live. But together, they're still a small part of who gets seen on a billion visits a year across the healthcare industry. They're doing 20 million between them, perhaps. And the health systems have actually gone from very few to doing maybe close to 200 million visits. What are you telling your health systems that you're working with in terms of, should they be doing this themselves? Should they be working with external vendors? I'm curious if you have a viewpoint on that you share with, Deloitte does work with a lot of health systems. I'm not sure if you do, and or if you're working with other digital health vendors, how they might work with the typical base of health systems versus going to direct to consumer. What are your thoughts on that?
Yeah, it largely depends on the size and scale of the organization, the culture of the organization, whether or not organizations have a track record of developing alliances with third parties versus developing their own technology in-house. I think we see it all over the map. Depends on geography, scale, therapeutic class, et cetera. I think you'll see, all of the above in certain organizations around the country. Some will do both. It will depend on a number of different factors, including, as I indicated before, reimbursement and the regulatory environment.
Okay, Jalandra, I wanted to ask you a specific question on the public market. We have seen a couple of interesting companies IPO as SPACs in the past year. Amwell, FHIMSS, Specialist on Call, UpHealth. They've not done well. None of them are even, I believe, at the price that they came out as. What do you think's going on? Is the industry just have too many telehealth companies, or SPACs just have inherent problems? Are these companies coming out too early, or are they not meeting the growth expectations people expected? Curious your take, as we're probably going to still see more of these, but those four in particular, and if you know of others, let us know, don't seem to have had the same trend and trajectory as Teledocs did.
Look, first of all, I should mention one thing, that if there is a company which is just providing only urgent care telehealth, is not going to succeed. Telehealth has become a commodity, right? You got to have things beyond, and that goes back to my point earlier, like how combining Livongo's chronic care management, remote patient monitoring programs with telehealth capabilities and Teledoc's membership base makes it a much powerful entity versus being a just pure play urgent care telehealth company that I think there are very few companies which are going to survive in that area.
Sure.
Now, keeping that in mind, clearly one argument which I made earlier, was that as long as we stay in this transition phase where we have seen how tailwinds came from COVID and from innovations and better consumer awareness, but lack of clarity how things will look in the post-COVID world is still it's out there. I mean, we don't have good data points on that. So as long as we stay in this transition phase, I think we are going to see stock remaining very volatile. Beyond that, there have been some issues. Some of these, in fact, of 13, 14 companies I cover in digital health, 80% have come public in the past 12 months. So it's still very young industry. The industry is evolving. Investors' knowledge about the industry is evolving, but there are some general themes which have come across. Lack of disclosures or lack of proper disclosures. A young company who has been in the industry for only 2-3 years, they're careful in terms of what data they're disclosing to public market, because they don't want to be at any competitive disadvantage because their competitors are all private. Investors want more information. You cannot come public, you're young, you probably have to be giving a lot more disclosure. So that's kind of a little disconnect, like how much disclosure is enough. And clearly, when you're trying to learn about the industry, about the company, you want more and more disclosure. So there's disconnect on that side. I talked about back to normal headwind. A lot of these companies have been talking about that they can hit a certain positive long-term margin. Most of the companies in my space in digital health are losing money, like down a -5%, -10%, but you're promising we can get to 15, 20% margin long-term. It's a big gap. Are people very comfortable? Now people are focusing on, yes, you're growing top line really well, but is that top line coming at a right contribution margin? Can you really grow top line and also keep improving margin? There's a little skeptical view there as well.
And a recurring question in that area is, we're often valuating, giving valuations as a tech company at 5-10x to revenues.
Mm-hmm.
But are these telehealth companies really more of a service company? Are they really more like a large primary care group or medical group? In which case you might have high revenues, but this is shades of the physician practice management market of the 90s, high revenues but very low margins, because most of those revenues go to pay the physician, et cetera.
Yeah.
When you look at it, when you do valuations, how do you do that? And especially when they're blended. In the Teledoc case, Livongo was very much more of a tech company versus a physician virtual provider company. curious, in your mind, is there a safe, better way to do valuations, and are the valuations coming out starting to say, hey, we're going to evaluate you like a services versus a tech company?
No, I mean, no way. I mean, you can value these companies like a SaaS kind of multiple, right? I mean, because SaaS companies have 90% gross margin. And you did mention that, I mean, how even for telehealth, you have to pay these physicians. The gross margins are never going to be like 90%, right? It's 50, 60, or sometimes lower. So, no, I mean, clearly SaaS companies are getting much higher multiple. The digital health companies with these kind of gross margin profile are at a much lower multiple. So we're talking about, ranging from low double digit kind of range, plus minus. So yeah, I mean, I think that we can use that as a benchmark, that this is where good gross margins SaaS companies are trading at. Then you put a discount to that, that's saying, hey, look, gross margin and EBITDA margin profile on these companies is much lower than SaaS companies. So you got to discount the valuation point of view. The other data point I want to mention quickly, the two data points, the why shares are under pressure, increased competition. I mean, today we talk about all these individuals companies for digital health solution, but look at the companies which are really making noise and gaining market share. Zoom. Did we ever think about Zoom being a major telehealth player 2 years back? No. Microsoft Teams. You have Amazon making a big push, Google investing. I mean, Microsoft. I mean, I think digital health adoption is driving increased interest from more players, more well-established technology companies, not just tech. Look at Walmart investing in telehealth. So I think, and pharmacy. So my point is that there's really a lot of competition has increased in the past 12 months, which makes sense given the market is now so attractive, but it puts pressure on your traditional digital health companies. And the last thing I'll mention is SPAC. I think a lot of these companies came public via SPAC process. I mean, people have very skeptical view about companies using SPAC as a way to come public. Unfortunately, I'll say probably 3/4 or maybe 60% of companies have underperformed. It may not be, it might be related to the way things have trended in the past 6 months, the industry macro trends. But people have a little skeptical view about the SPAC, companies coming public through that vehicle.
And quick question on SPAC, do you think that the issue is inherently how the SPACs are set up, or simply that the companies using the SPAC are often not as mature as a traditional IPO, and therefore it's not the structure, it simply is the content of who's going on SPAC?
Well, I don't want to make it very like a broader comment that all SPACs are, I mean, there are some good companies which have come public via SPAC and are doing really well. Fundamentally, they've exceeded expectations. But there are, I should probably say, 6 out of 10, 7 out of 10 companies which have underperformed. And that makes investors believe, a feedback we get is like, maybe these guys are just giving out these very rosy projections for next 3 years to get the SPAC deal done. But in fact, they don't have good plan or drivers in place to hit those projections. So that's one. Second thing is that there's again, these are not my view, investors' feedback that maybe there's not enough due diligence done on these SPAC and the kind of process you follow in IPO, which takes much longer time frame, but it's a lot of detailed review and due diligence done in that process. So that's another reason why people have a little skeptical view about these SPACs outperforming these companies. But I'll repeat, there's some really good companies which have come public via SPAC and doing really well.
Yeah, so it seems that they attract sometimes the earlier companies that aren't meeting the predictions. Michael, let's talk about one of the big trends out there, of course, is M&A growth, et cetera. But another trend in telehealth are the niche companies that are often doing very focused, specific area. I'm curious if, when you look at these, you're looking for those who maybe can help the underserved, et cetera. How do you, when you look at them and think about business model and valuations, how does that work? Some of them, I've seen are getting very large valuations, even though their total addressable market may not be that large. Curious how you're looking at these, deciding if and where one should invest, provide money, support them, et cetera, because unfortunately, if you're serving an underserved market, that may mean you don't have as good of a business model, for example, of a lifestyle company selling, ED or hair loss meds for direct-to-consumer cash, whereas taking care of an underserved community, may not have as much money, although, of course, there are government funds. But what are your thoughts on some of those niches that you've been seeing, and what is a great business model that you've seen for those who want to go into that area?
So thank you for the question. In terms of the niches that I look at, there are two that I look at right now. And these are driven by the fact that there's a shortage of doctors and nurses in the places where I operate. And so even if we're maximally training the number of physicians and nurses and advanced type of nurses, you will still need other tools that can help you do some of the initial screening and to be able to engage with people after any would-be in-person visit. So I do look at on either side of that experience. And those include things that are looking at AI and machine learning to be able to screen, radiographs and things like this so that you can get an early indication. So in the market where, some of the markets where I operate, cancer is often detected at stage 4. That's a really difficult place to evaluate someone and then win that war. So I look at things that catch that very early on. And some of these can be extremely low cost with very large addressable markets because they are in public payer systems. So in the United States, that is not the way, or broadly speaking, it's not the way it's laid out, but in Europe and in increasingly in India, they're going to be rolling out a single payer system approach. And so it's in their vested interest to get these early diagnostics out there so that they can help people sooner versus later in any particular disease stage, which would be much more expensive. So I look at a lot of that type of technology. The other thing I would say is in terms of medical devices, it's really interesting. If you look at type 2 diabetes management or type 1 diabetes management, the actual device itself, a glucometer, is ripe for serious competitive innovation. In the developed markets, like $1,200 a year. And then if you want to think about that, for someone in an emerging market, that's incredibly expensive. That might be their, half or all of their annual salary. But the device itself is not, the component pieces of it aren't something that require rocket science per se. So I think like devices that serve really big markets right now, you should take an eye on some of these low cost resource environments because they're going to innovate medical devices, which then, to Peter's point, if they make it through the regulatory hurdles, could be really interesting for a place like here in the US, where you could then dramatically lower the cost of these things at the same benefit and same kind of digital data being thrown off that empowers all the participants around it. So those are the things.
And let me follow up a little on that, because I'll often define the umbrella term of virtual care includes both telehealth, which is the traditional doctor-patient, whether it's synchronous or asynchronous, and then another component that's autonomous care, AI, et cetera. And it seems like a place like India, where I'm sure there are not nearly enough doctors for all the patients. I think you're saying there's a sort of public, system or single payer for a lot of patients. Seems like the ideal place to really test out, so to speak, or be early adopters for this autonomous type of care. Do you see any companies out of the U.S. coming to India first because maybe is the regulatory bar lower? Is the ability to use the phone to do everything from check your blood pressure, temperature, and glucose to actually autonomously manage a patient's care, minimizing how much a doctor's involved? Is that going to happen and be widespread in a place like India well before the U.S.?
So I think India has a fairly rigorous regulatory environment. So it's not a low regulatory environment, but what their government is thinking about is how to be innovative and serve that many people. So it's a very different dynamic because they, at the end of the day, are going to be the payer. And they do want a healthy, thriving population so that they can grow as a country and their economy. So I think that in an environment where you see large populations with some level of wealth in the nation already as a really good boomerang technology environment. So I think you're going to see more and more people trying these low cost, high quality, high benefit, in terms of like what the device can do, technologies coming back. And in terms of the AI and machine learning, the good thing about that is that can be created anywhere and distributed anywhere as long as the regulatory environment and the reimbursement system engages it, because it's all about understanding how to create the better, smarter algorithm for this. And I think you're going to see more of that everywhere. You can already see this in other industries, including in the consulting world. They'll have very large groups of people in India and elsewhere who are doing a lot of the frontline research, and then that gets brought up and further bolted on with high quality professionals in other markets. So in India, I think what's going to happen now is that you're going to have a phenomena, and you're seeing it now. There are finally people really investing in that market. That many of these Silicon Valley companies are actually Indian companies. They'll have like maybe 1 or 2 people in Palo Alto and 100 in India. Well, if they're the people designing it, it doesn't take that long now for them to say, wait a minute, I actually could create this as well. So I think this is what you're going to see and beginning to see with private equity investors like Carlyle Group and others really taking a big presence in India, because they understand, oh, this is actually where a lot of this is being built to begin with.
Makes sense. Okay, little speed round. Peter, starting with you. What are your predictions, through the end of the year? And beyond if you want, and particularly Jalandra mentioned earlier some big tech, getting in and out of healthcare. Amazon, is really pushing. Google is backed out. What's Microsoft doing? They're hosting everybody. But what are your thoughts on what's going to happen over the next couple of months through the end of the year? And curious if you have specific thoughts on Amazon and other big tech getting into healthcare.
Yeah. So maybe a follow-up point on the investor lens, because we speak with a lot of investors in this space. And investors are looking for solutions. They're looking for organizations that have solutions to massive healthcare problems and not necessarily technology. To your point, technology is ubiquitous, becoming commoditized. We do see a focus, and we predict artificial intelligence will be an important part of the overall solution to healthcare issues like access to healthcare, affordability, the cost of care, the adoption of value-based care paradigms in the regulatory environment. Our view is that is what's going to get funded, and not necessarily technology, but technology through either a managed service or some intellectual property, software, or even just a service that's collaborated with clinical experience to solve a macro healthcare problem will get funded. That's our view in the future of health with respect to this industry.
Okay, and quickly, Michael, any thoughts on what you see as any big, cool, new things happening through the end of the year? Any predictions or thoughts on big tech or other?
So one of the areas I'm really keenly looking at is diabetes care. And I do think that there will be, maybe not by the end of this year, but over the next couple years, serious innovation in the device space. Once that happens, you're going to be able to have a much larger addressable market, which is about 500 million people worldwide. I think the other area that I spend a lot of time looking at are NCDs and insurance companies. These are the two that actually have aligned interests to find solutions towards this. Insurance companies want healthy people, and working at the margin with the sick people, right? Unfortunately, right now, if you look at their total population, it's mainly chronically sick, and they're trying to manage down costs. So I think anything that has to do with behavior change is going to be really interesting, and that these two areas are going to be most aligned. And the final one where I spent a lot of time is in mental health. I don't think this is going away now. I think COVID allowed people to talk about mental health. This is a worldwide issue. I don't think digital technology is the only solution to it. It's certainly going to be an important part of it. I think valuations are all over the map in that category, but the overall trend of digital tools being used in mental health as an early part of that process and mental health care, period, having a seat at the table from investors and from opportunities from engagement from consumers will be large.
All makes sense. Jalandra, you want to take us home with 1 minute, talk about new entrants, big tech, cool stuff you think is going to happen by the end of the year?
Yeah, I would say, I mean, first of all, I do agree with Michael about this chronic care focus and mental health focus. I think employers and providers, employers in particular, insurance companies are not losing their sleep over, hey, why did my employee show up in urgent care and cost me $100? They're worried about their chronic care population. They're worried about employee well-being, total population health. I think that will be the key with their core focus. But in terms of your core question, like what I think that as something to watch for next 6 to 12 months, I think we have to watch for more M&A, more consolidation. I mean, look at what has happened in the past 6 to 12 months. Teledoc, Livongo, we talked about, One Medical, Iora, Grand Rounds, DoD, Headspace, Ginger, Omada, Fisera, Acro. I mean, the list just goes on and on. The fact is that companies not having done a larger deal and providing one-point solution are now facing an uphill battle when it comes to bringing more comprehensive set of solutions to the market, to employers and health plan. People are looking for more one-stop shop where we can have best of brand, like best solutions out there. And it's not just beyond the rationale of these combination goes beyond just integrating the products and services and having more comprehensive solution. Rather, the large transactions essentially open up new channels and potential customer from both sides, where there is already a relationship. So I think we're going to see a lot of M&A, a lot of consolidation in the digital health space.
Yeah, I agree. I think that they'll make a lot of sense. Listen, everybody, thank you so much, Jalandra, Michael, Peter. Great to talk about all this stuff we love. Maybe our wives think it's geeky, but hopefully the listeners enjoyed it. So thanks again for your time, and hope everyone enjoys the rest of the conference.
Thanks for having us.
Thank you.